How to invest for higher interest rates. I'm going to reveal some secrets of the pros that'll help you make better financial decisions. And I'm going to explain this to you in 3 simple, fast steps. Step number 1, let's go over why the price of gold has been going down. I don't want to make this entire video about gold, but if we can figure out these dynamics, we can understand what the market sees coming in the future and whether or not the market is correct based on the probabilities. Let's start with a chart of the CPI, inflation as measured by the government. So we know that's probably understated, but this is what the market's going on. And this chart goes back to 2001 all the way to 2021 today. And we're going to project it out the next 5 years. On the left, we go from 0% inflation down to -4, so 4% deflation, all the way up to 6% inflation. In 2001, inflation, as measured by the government, right around 4%. It dips down, pretty much goes straight, just churns a little bit. And then we get to a peak just before the GFC where it crashes down. And we had a brief time frame where we experienced price deflation, according to the government. Okay, that's the last time I'll do that. You guys get it. And then CPI goes up. It stays pretty consistent, but then it's kind of been on this downward trend, a little up in 2017, but then it really falls out of bed in March 2020 with the cerveza sickness. Now, the CPI official number is right around 1.4%. But I'd like to point out the Fed does see inflation increasing in the future. But according to Jerome Powell, it might get up to about 1.7%, a huge increase, as you can see. Now, the market disagrees. The market thinks that inflation will be higher, although probably not as high as the majority of the people watching this video that are actually buying stuff like groceries on a daily basis. So how does the market come to this 2.2%? This is very important. We think this through. It's basically the spread between the 5-year treasury or the 10-year treasury and the equivalent TIPS. Now, TIPS is an acronym that stands for Treasury Inflation Protected Security. It's a way to buy government debt and not have to worry about inflation. But of course, they're only going to pay you on the CPI. So if that's understated, it's still not a real good deal. And there's some other dynamics there to understand. But the main takeaway is inflation expectations are usually measured by the difference between the 10-year Treasury, the nominal rate, and the 10-year TIPS, Treasury Inflation Protected Security. And right now, the delta is about 2.2%. So again, the Fed is projecting about 1.7% CPI, market 2.2. Let's go down to this bottom chart. We've got the 10-year Treasury yields, and we start, it's just a 1-year chart, going back to the cerveza sickness, March of 2020, all the way to today's date. On the left, we go from 0.5% or 50 basis points up to 1.5%. It really went down because the market was expecting deflation because of all the demand shock that we had, everyone being locked in their house. But since then, it's really gone up. And in 2021, it's gone straight up. Mind you, it's only at 1.5% today, but the trend has really been going straight up. So what is the price of gold telling us about the market's expectations for the future? Editor, let's go ahead and throw up a chart. This is a chart of interest rates on 10-year treasuries adjusted for the rate of inflation. And if we layer over a chart of the nominal price of gold, you'll see that they're tied at the hip. There's a strong inverse correlation. So if real interest rates are increasing, going positive, that's negative for the price of gold. If real rates are going down further into negative territory, let's say, that is beneficial for the price of gold. And if we go back to our charts, this makes a lot of sense. The market is telling us over the next 5 years, it expects the inflation rate to be about 2.2%. But the 10-year Treasury yield is going up significantly, and it's on a trajectory that's at a steeper slope than the rate of inflation. So this is telling us the market expects real interest rates to continue to increase into the future. And for those of you watching this video who think we're going to get a lot of inflation in the future, you're probably scratching your head and saying, how on earth can the market only be projecting 2.2% inflation over the next 5 years? To answer that question, let's go to a clip of CNBC where Jerome Powell tells us that he thinks inflation is only temporary.
A bit of a head scratcher about what Fed Chair Jay Powell might have said, prompting bond yields and stocks both to sell off pretty hard, with some pointing to his comments on inflation, very dovish comments, and his failure to commit to act to keep a lid on yields. Powell striking a very dovish tone when it comes to the outlook for Fed policy. Among the things he said, he did note that he had seen the speed of the rate hikes or the yield rise. Previously, they, quote, caught my attention. And he struck a dovish tone, saying it will take some time to achieve substantial further progress, which is the metric the Fed uses to change its policy. And adding to that, saying Fed's not going to hike just because the labor market is strong. Now, Powell essentially reiterated comments he had previously made that higher inflation is coming, but believes it will be temporary and will not be a reason for the Fed to act preemptively to hike rates.
Businesses and people would need to believe that larger increases in prices would be repeated year after year, and we think it's unlikely that these deeply ingrained low inflation expectations would suddenly change. It is more likely that effects like the ones I described would be one-time effects.
Going into this speech, it may be that market expectations for the Fed to act to lower long-term bond yields had risen to the point that Powell's failure to embrace the possibility sparked the sell-off.
So our monetary overlords at the Federal Reserve think that inflation is going to be temporary. And this is a result of a lot of Keynesian models that get into aggregate demand, aggregate supply, and what the real or the proper rate of unemployment should be in the market based on economic factors. We're not going to go down that path in this video. The only thing you need to know right now is that the Keynesians and the 900 PhDs at the Fed think that although there has been a small tick up in inflation, it's only temporary. Another main takeaway from the clip is Jerome Powell didn't signal that he'd be buying any more bonds that he's already buying at the long end of the yield curve. A lot of economists, and myself included, expect the Fed to do something called Operation Twist. Maybe not now, but over the next 4 months when Janet Yellen has to spend all that money in the TGA. If you don't know what I'm talking about, I did a whiteboard video on it. We'll put a link in the description below. But Jerome Powell didn't signal that he was going to be buying any additional bonds on the long end, so any more 10-year or 30-year treasuries. So this is why interest rates really spiked up and have continued this trend upwards, because the market is taking the Fed at their word that, number one, inflation is going to remain low or be transitory. And number two, they won't buy any more 10-year or 30-year treasuries, regardless of how high interest rates go. In other words, they won't do any yield curve control. But the main takeaway I want to emphasize from step number one is the market sees real interest rates continuing to go up in the future. That's brought the price of gold down. The dollar has gone up on the DXY, which is a measurement of the dollar against a basket of foreign currencies, mostly the euro. And we're seeing market rotation from growth stocks into value. So now that you understand how these market dynamics work, we're going to go over some highly actionable intel in steps 2 and 3. So for once, take that stiff drink, set it aside, and grab a notebook and pen, because you're definitely going to want to take some notes. Step number 2, growth stocks versus value stocks. Usually one is outperforming the other, and a lot of times it has to do with interest rates. Let's start by looking at a chart of these two types of stocks going back to 1988 all the way to 2018. And if we took that chart even further, you'd see this relationship would be holding true over the last few months as well. So it starts at 0%. This is kind of the midline in the chart. It goes up to 150%, down to 150%. Basically, what this chart is telling us is by what percentage the one category of stocks is outperforming or underperforming the other. And I kind of simplified it. Editor, you can throw up the chart. It kind of is a little more squiggly, but I made my lines a little straighter here just for the sake of time, and I think it's easier for you to understand the overall concept. So from 1988 to 1998, as you would imagine, growth stocks really outperformed value stocks. We think of the tech boom and then the tech bubble. But as we know, the tech bubble came to an abrupt end where growth stocks plummeted and value stocks went up as a relationship to their counterpart. Then value stocks outperformed until about 2008. Of course, we know what happened then. The GFC, the Fed drops interest rates to zero. They go through zero interest rate policy, or ZIRP, for basically 12 years. They went up a little bit there at one point in time, but then they immediately went right back down when they had the taper tantrum in 2018. But as you can see, as interest rates went down after the GFC, the growth stocks started to outperform the value stocks. And recently, over the last few months, since interest rates on the 10-year Treasury have been going up, like we discussed in step number 1, you can see this rotation start again where the market is selling growth stocks and buying value stocks. Look at the difference between the NASDAQ and the S&P 500 as an example. Let me be clear, I'm not saying the cycle has started and value is going to outperform for the next 10 years. I'm saying we've seen these cycles happen in the past, and we could be at the start of another cycle right now. It's something we need to be cognizant of, especially if you have a 401k where you have the option of being in a growth fund or a value fund. But let's think through why this happens. First and foremost, we have to understand the time value of money, or I think of it as just kind of an opportunity cost. So let's go through a small example. We have the average Joe with a big smile on his face because he has $100 that he's going to invest. And let's just say he wants to invest it over the next 5 years, and the interest rates, unfortunately, for Joe are 0. So he can't go out there and just buy a 10-year Treasury and get a decent rate of return, or any rate of return. It sounds familiar for a lot of you over the last 12 years, I'm sure. But then we've got Mr. Elon Musk here, and he's got red eyes because he just got done, most likely with the Joe Rogan show. And he's got his Tesla Cybertruck right here. And he says, listen, my company's going to grow. We're going to print money over the next 5 years. We're going to have all of these profits. And therefore, I can return that $100 you invest in my company. So now we have to ask ourselves, compared to what? If Joe just kept the $100 in his bank account or bought treasuries, and at the end of 5 years, he'd have the same $100 that he's getting from Elon Musk, it's pretty much a wash. It doesn't really make a difference until we get into the risk premium, which we'll talk about in a moment. But let's just assume that Joe could get a 10% return if the interest rates on the 10-year Treasury went up, as an example. So at the end of 5 years, he'd have $110. Well, now the $100 that Elon Musk is promising has a lot less value to the average Joe because he can make $10 by investing his money elsewhere. So if the current value of the company's future cash flow goes down, then usually so does the share price. And it's not just about the time value of money. It's also the risk premium we mentioned earlier. So let's think this through. A company like Mr. Musk, car company, Tesla, lots of R&D, a lot of unknowns in the future. They might have to go back to the market and borrow more money if they're going to set up manufacturing plants for semi-trucks, for the Cybertruck, for the Roadster. Who knows what they'll do. But if they have to go back to the market to borrow money, then they'll have to borrow money at a higher rate of interest. Therefore, their payments will be higher. That could decrease the amount of cash flow. Also, let's think about demand. If car loans right now are, let's say, 2%, that's going to create less demand for all cars, not just Teslas, if the rate of interest on an auto loan goes up by, let's say, 8%. So if demand goes down, so could cash flows. Then currently, a lot of these companies, maybe not Tesla, but Uber, Lyft, DoorDash, they make absolutely no profit. In fact, they hemorrhage money. They flush it straight down the toilet. They get it from the market and light it on fire. In one quarter, I remember Uber lost $4 billion in one quarter. I believe that was in 2019. Editor, throw up that stat real quick. I can't remember if it was 2018 or 2019, but they lose staggering amounts of money. In fact, another headline I saw the other day showed that like 60 or 70% of the companies that went public in 2020 or 2019 actually didn't make any money at all. They were losing money at the time they had their IPO. So if you're a company like Uber that's just burning through money when the economy has very low interest rates, therefore money is easy, how much money are you going to be burning through, or what are the probabilities that you'll actually be making a profit if interest rates in the real economy are at 5% or 10%? The probabilities are much, much lower. Therefore, the market would attach a higher risk premium to your stock. Higher risk premium to your stock or future cash flows means the price of your shares go down. So the main takeaway from step number 2 is when you compartmentalize growth stocks and value stocks, they run in cycles of outperformance. And right now, due to interest rates increasing, if you're someone that believes that interest rates will continue to increase, you've got to start weighing the probabilities of us moving into another, let's say, 10-year cycle like we've seen in the past, where value is actually overperforming growth. Step number 3, is the market actually wrong? Everything we've talked about in this video assumes that nominal rates and real rates are going to go up in the future. But what if the market is incorrect? What if the market's offsides, if you will? Let's look at a couple charts. The basic yield curve. And I've got 4 of them here. I just did the first one with the timeline, 1 month, 3 month, 1 year, going all the way up to 30 year. On the left, interest rates going from 0% up to 3%. Pretty much the same here. I think you guys get it. So the first yield curve we have is right now where Jerome Powell in the Fed is saying there's no problem. Interest rates can continue to go up and inflation is only temporary. But you know from watching this channel, at some point in time, interest rates in the real economy or the 10-year is going to go high enough to where it really cripples the real economy. Why? Because the debt is enormous. The consumer debt at an all-time high, corporate debt at an all-time high. State and local government, all-time high. And of course, the federal government at $28 trillion in on-balance sheet debt. That doesn't include the potentially hundreds of trillions of dollars in off-balance sheet debt. So my point is the debt is so high, at some point, those interest rates are going to take us straight into the no bueno zone, where even Jerome Powell and the Fed will have to admit, okay, now we've got a problem because something breaks. Either the stock market breaks, the economy tanks, something happens that gets them to change course. So what would their options be? We've heard a lot lately about yield curve control. This is where the Fed comes in and just buys all the 10-year and 30-year treasuries they need to make sure that the yields on those 10-year treasuries or whatever they're buying isn't going above a certain rate. So we're not going into the no bueno zone. This keeps interest rates in the real economy in check so the whole house of cards doesn't come crashing down. But as you can guess, there could be a problem. The way the Fed would buy those treasuries they need to buy to cap rates and to execute the yield curve control game plan would be to print additional bank reserves. That's what they use to buy those treasuries from the commercial banking system or from the average Joe, from anyone for that matter. But let's just say they're buying them directly from the banks. And this could create a negative interest rate at the short end of the yield curve, which could blow up the repo market. We talked about this in a video the other day. So a lot of economists have come in and say, okay, well, they don't necessarily have to just do yield curve control through their typical quantitative easing. What they can do is this Operation Twist 2.0. This is basically where they take the T-bills or the short-term treasuries on their balance sheet, they sell them into the market, and then at the same time, they buy the long end of the yield curve, trying to cap those rates. So if they buy just as much as they sell, the net amount of bank reserves in the system would be unchanged. But there is a problem. The Fed only has $300 billion worth of T-bills on their balance sheet, so they don't have a lot of firepower. So at the end of the day, they wouldn't have enough to sell to make up for what they have to buy in order to execute this yield curve control long term. So that brings us to their only option, which is, going back to my favorite comedy as a kid, In Living Color, they have to print mo money, mo money, mo money. Editor, throw up the clip.
More money, more money, more money.
Now, assuming this doesn't wreak havoc in the repo market, theoretically, they could continue to do this, but it may increase inflation expectations. More on that in just a moment. Now, those of you who are very sophisticated are probably scratching your head right now and saying, George, wait a minute. If the Fed is just creating bank reserves, that doesn't necessarily create more currency units in the real economy chasing goods and services. Therefore, consumer price inflation. And you would be correct. That's why I always try to draw that distinct line in the sand with the commercial banking system's balance sheet to compartmentalize what's going on in the financial economy and in the real economy. So if the Fed is just creating bank reserves, that's just affecting the financial economy if it does anything at all. But without the help of the commercial banking system creating more loans, which means more currency units, it really doesn't seep into the real economy. But now we have a completely different situation, in my opinion. The government, going back to 2020, has instituted massive amounts of stimulus. You've all heard it. The government's sending everyone $1,400 checks, $600 checks, $900 checks, increased unemployment benefits. who knows what it's going to be next. And my theory is that our economy is just like good old heroin guy from the streets of San Francisco. And once heroin guy gets addicted to the monetary heroin, and of course you can replace him with our economy, you can't take it away without killing the person that's addicted to the drug in the first place. Let's use welfare as an example, or even Social Security. There's a large percentage of our population who has built their lives around the ability to receive government transfer payments. And you can like it or you can not like it. That's not what this video is about. But the bottom line is, if you immediately took away welfare, or if you immediately took away Social Security, that would be hugely detrimental to our economy at large. Well, what we've done since 2020 is we've built an economy that's now completely dependent upon stimulus. In other words, government fiscal spending. And now, really the only way for them to continue this fiscal spending is if the Fed monetizes the debt. If the Fed monetizes the debt, that means there are more currency units in the real economy chasing goods and services. We're going to have to permanently prop up our economy with monetary heroin, just like heroin guy has got to prop himself up with more and more of the drug. So what does this mean? That takes us right into a situation where inflation expectations increase dramatically while rates are flat because the Fed is executing the yield curve control game plan. So this would create an environment where real rates are going down, where right now the market is expecting real rates to continue to go up. So what does this mean to you, the average viewer that's just trying to make better financial decisions for their future? Well, if you're someone that believes the Fed is going to implement yield curve control and inflation expectations are going to increase, then you also believe that real interest rates are going to go down, not up. And if gold does poorly in an environment where real rates are going up, the market for gold right now could be offsides, to use some industry lingo. So my point is, if you don't own any gold whatsoever, now may be a good time to look into the value of having some of that shiny rock in your portfolio. And I don't talk about it much, but I actually have an online forum for people who are really serious about taking their investing to the next level. We not only talk about gold, silver, Bitcoin, we talk about inflation, deflation, interest rates, the dollar, dividend-paying stocks, value stocks, growth stocks, you name it. I partner with two of the best in the business, Lynn Alden and Chris McIntosh. The online investment forum is, of course, called Rebel Capitalist Pro. So for more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, don't check out this playlist, but check out the $1 trial offer we have going on right now as a special promotion for Rebel Capitalist Pro. We'll put a link in the description below.